Welcome, everybody. Welcome to the second edition of our estate planning webinars. Today, we're bringing you Connie Gale from Wellington-Altus Private Wealth, part of our advanced financial planning group. I just want to remind you all, this is the second edition of our estate planning webinars. And the first one, which we did on representation, is available on our YouTube and X channels. And you can find that just by putting that into any search engine. We've wanted to maybe open up a bit about why we're wanting to cover this topic. The bottom line is that what we're seeing as a practice is that estate planning is becoming a bigger topic of conversation in general with clients. And life insurance and insurance in general is a key tool to be aware of because of its inherent tax advantages, diversification as an asset, and liquidity delivery advantages for both individuals and inside of corporate structures. And as we've been having these discussions, we've noticed that there's a lot of myths and misconceptions and a lot of interest. So what we wanted to do here today was just to bring a bit of an education session here from an expert, much like we did with on the will and executor side of things. So I'd like to take a moment here to introduce Connie Gale. Connie is Associate Vice President of Wellington-Altus Insurance, and she joined our firm back in 2019. She began her journey in the wealth service industry at one of Canada's largest and preeminent insurance companies and has obtained both life and investment licensing designations. All right. She values employing a holistic approach and to serve the best interests of clients, and has spent many years fostering strong relationships and helping clients to build and manage their wealth. I mean, I would say from her interactions with our team is that she's a pleasure to deal with and really wants to make sure that insurance fits in a planning context. Connie is passionate about educating both advisors and clients. And, at the end of the day, she graduated from the University of Winnipeg with a bachelor's in education degree. And she is a certified financial planner, and she holds her CHS designation as well. Outside of work, she loves to cook. She enjoys traveling and is a fanatic about baseball. So as you can maybe guess, between May and September, she can be found at Shaw Park in Winnipeg with her husband Clint and daughter Madison, cheering on their hometown Winnipeg Golden Eyes. So I guess let's go Golden Eye. No reference to Pierce Brosnan there. And maybe I'll just let Connie introduce, add anything to that introduction, and then let's get right into it.
Oh, I appreciate that. Thank you very much, Conrad. You alluded to my education or my degree in education from the U of W. When I graduated way back, you couldn't buy a teaching job, and so I started my career in the insurance industry because I couldn't find a job doing what I was actually trained to do. So I guess it was kind of a good thing. I started at Sun Life, actually, for what became to be known Sun Life. Moved on to some of the bigger bank-owned firms, added some investment licenses, worked in a very similar capacity to Conrad and his team until I realized that really my passion was insurance. And then the universe delivered when I was given the opportunity to build the insurance department here at Wellington-Altus. 6 years ago, 2 days ago, actually, I celebrated my 6-year anniversary. And I get to work with advisors like Conrad, their clients, to find the best ways to protect and enhance what they've worked so hard to build. I'm really very lucky to be doing exactly what I feel is the best spot for me. So thank you for having me on your webinar.
Thank you very much for joining us. So I think today's format, we're going to try something a little bit different. I know in the past we've had our presenters make a presentation and then we have a bit of a Q&A session. But I thought just given that we've seen a lot of questions from clients in this area, I would just more want to present this to everybody as more of a conversation and more of a Q&A, based on some of the questions we've seen. So why don't we just get right into it here, Connie, if you're good with that.
Absolutely.
So, I think one of the first questions we want to touch on is if you're going to start with something and you want to provide education, let's start at the beginning. Let's start at the base level. And what we want to talk about is, what are the main types of insurance to look at for estate planning, and how is that type of insurance where you're looking at, a product that helps you with estate planning different than, say, your home or auto policy or your travel insurance policy?
Good question. It's funny because insurance, there's so many things to think about when you're looking at insurance. And when we're looking at the key to successful estate planning, we want to make sure coverage is there when you need it. So term policies are designed for short-term needs like income replacement, debt coverage, things like that. Most term policies are designed to expire by age 85. And so when we think about life expectancy of the typical Canadian, we're looking at least 87. Typically, some people have longevity. So if we know that a term policy is going to expire at age 85, we know that that's not going to prove or provide exactly what we need to make sure that there's coverage there. So when looking to implement insurance for estate planning purposes, we want to look at permanent coverage. There's a few different options in that realm, but the main three are usually term to 100, universal life, and something called whole life insurance. I can kind of go through what those types are at a high level if you like, or is that something
I think that would be useful for everybody, and
sure.
And maybe you could, again, just maybe give it some contrast between, say, what you expect with a term or a home and auto policy, where frankly the insurance company is hoping it doesn't pay out, versus a permanent policy where there's certainties involved.
Exactly.
So I'll let you take that away there.
That's actually a really good point. Again, term insurance designed for a specific need. When I was first getting into the workforce, had a very young family, you buy term insurance because it's cheap and because it will be there if a catastrophe happens. Because really, when you're in your early 20s, chances are you've got a bit of a life expectancy ahead of you, unless, of course, you're in an accident or you develop an illness that doesn't successfully resolve for you. But realistically, the premiums that are paid into most term policies are wasted by the time that term either expires or runs out, like I said, at age 85. So when we look at the permanent side of things, we look at a term to 100. It's a no bell, no whistle type of insurance policy. It's the lowest cost of guaranteed coverage. The premiums are guaranteed for life. They will never increase. And it's best suited for people who have a desire to leave a certain dollar amount to their families and are prepared to pay that cost of insurance for their lifetime. So just like the name, term to 100, costs for that coverage will continue along right up until age 100. So it's a great option, again, for people who know what they want to leave and don't really want to put a heck of a lot of dollars or thought into that policy. The second type that we talked about briefly is a universal life policy, and they were really popular about 20 or so years ago during our my first actual bull market that I recall, just prior to 2008. It comprises of an insurance portion and then an investment portion, and they are very, very separate, but form one policy where upon death, both will pay out tax-free to your beneficiaries. So it's a nice spot to be able to shelter some money while staying invested in the markets. Wide variety of investment choices, fixed income, Canadian, US, global equities. But the one thing you need to remember is that you and your advisor need to be managing these investments. When I say that, I remember they were popular before 2007. If everyone remembers, 2008 was a bit of a volatile year. Volatile downwards. And so a lot of these policies, because they may or may not have been managed properly before that time, really lost a lot of their values and then fell off the radar and weren't as popular in the years after that. I like universal life for certain situations. Again, a minimum funded universal life can be a nice permanent plan that we know what the cost of insurance is going to be. We know what the insurance benefit's going to be, and we can find investments that are going to be manageable. Again, you've got access to the cash. That's always a really nice option to have. In case something goes wrong, you need to have a little bit of extra cash on hand. You can get at it very quickly. But again, anything withdrawn from one of these policies will be taxable. I'm sure that most people have heard of something called whole life insurance or participating insurance. This is basically another form of permanent life insurance that will provide you coverage for your whole life. So if you have longevity and you live to 104, this policy is still going to be in place. Guaranteed premiums and often a guaranteed minimum cash value. The investment portion of these contracts, though, are managed by the insurance company. So we don't have to have any input on, do we stay in Canada? Do we move to the US? Do we need some fixed income? Can we stay in equities? All of that thinking is done by the insurance carriers. And most of these carriers, as you know, Conrad, they've got enormous investment teams and they manage pension funds, and they really do a good job of being conservative and making sure that those dollars are going to grow, but more importantly, be there when needed. Most of these policies will pay out either a bonus or a dividend each year, and there's several ways that dividend can be utilized. Is it okay if I go into a couple of those ways?
Why don't we maybe circle back on that,
Sure.
at the end when we have some time there. But I think that gives us a good overview of, the idea that, look, like this is, when you're looking at this for this application for estate planning, that
Yep.
really you're not talking about an expense, you're talking about building an asset base, and there's different ways to go
Absolutely.
about it, whether it's very plain vanilla through term to 100, or there's more bells and whistles added through universal life or whole life, just depending on the application and the client's particular circumstances, including thinking about things like longevity.
That's exactly right. And something that's very important to note is that working with a team like yours who do that planning, we're able to then find the right product. And that's something I want your clients to know, is that if someone comes to you with one product, it may be the right one, but there's always more to choose from. So
That's right. Well, I mean, that's why it's always very important to consider this in the context of planning. It's I think that's probably the most one that is like one of the single biggest considerations is this done in the context of a plan? Because we want to make sure, diagnosis without examination is malpractice. So we'll make that joke for all the physicians. I know who you are, Dan. You're on the call. You're going to get called out. All right. So let's think about it this way: is, again, even though from a financial standpoint, right, affluent families may not need, insurance, but why would they still use it in an estate planning context? Like, what's the use, even if you don't need it? And why do you see some of the, the wealthiest families in North America using this tool, even though it's demonstrable they don't need it? They don't need a dime of cover.
Absolutely. So when we traditionally think about insurance, we think of the risk management side, right? Again, I die early, I need to provide income for my family. Wealthier families love life insurance. And the reason is, as we know, CRA has reduced or eliminated most of the ways to reduce or defer taxes. Things like tax-free savings accounts are amazing. We love them, but they're severely limited in what you're able to do with them. Trusts are great. Trusts have a limited time frame to be able to shelter investments. When we look to insurance, we look to permanent, typically participating insurance, where you're going to have a cash value and a death benefit. And there's a lot of reasons that people like it. There's liquidity at death, very quick access to funds as soon as a claim is made. So people don't need to be forced into a fire sale of assets or properties in order to pay immediate bills. There's a diversification of the portfolio. And this is actually really key to a lot of the bigger portfolios in Canada. So we look at, the different types. So RSPs, non-registered tax-free savings accounts. Within that, you're able to have different levels of tax shelter, right? RSPs are tax sheltered while it's in there. Tax-free savings accounts, again, are amazing. Non-registered investments typically are taxed on the growth annually, and with the changes that are proposed to be coming, it could be even higher for the higher net worth families. What we're able to do with insurance is take a portion of those taxable funds, transfer them to a policy, and have them pay out tax-free. And really, that's the key to looking at this type of insurance. You have access to that cash value, which is amazing. And again, access to that cash value, and I'm not sure many people know this, fun fact, Walt Disney borrowed against his life insurance policy to start Disneyland because nobody in his life believed that it was going to be a success. So having options available is really what insurance is all about, is providing you different ways to make your goals happen.
Right. So if we just, summarize that, when we look at affluent families, the reason they use, estate planning, insurance becomes part of an estate plan in some cases, is that, you do have that ability, that liquidity that is there to settle tax bills. It is there to support beneficiaries and to transmit assets between generations. It diversifies their asset base away from, into another area. It gives them another type of asset that's not correlated to, the world and the business cycle at large. And, it gives them certain other flexibilities that might not otherwise be available with another product.
That's right. It doesn't force them into a sale at an inopportune time.
That's right. Yeah. We all know the CRA wants to be paid right away. And if, the market is, the market for, the assets that you own is not having a good moment, selling low and buying high is, we know, is the path to ruin. So it gives some flexibility there.
Absolutely.
Now, as we look at, we sort of talked about, again, like the types and why, the what and the why. Maybe if you could just maybe give a couple of high-level examples about how, popular strategies and how they work and how they, they most commonly apply.
Sure. I think the personal or corporate estate bond asset transfer, not sure what the name is, but it really is the most recognized strategy out there.
Right.
It's really simple. You buy a life insurance policy, a permanent life insurance policy. You transfer a portion of your assets over to it. Typically, we look to move and you and I have had this discussion, the bottom of the freezer funds, right? The assets that are never going to be spent, that ultimately are there for the next generation. We think to make them a little bit more tax preferred, we pick them up, we move them over. They increase in value throughout your lifetime. And then at the end, the insurance benefit is paid directly to your named beneficiaries tax-free.
Right.
And so I made a point of saying named beneficiaries because we want to make sure that we don't have a state named there. We want to have it going to, Joseph, Christine, the charity, whoever that might be.
Right. So you call it a bond because basically you've set up a certainty with a locked-in rate of return, on those assets that you're not gonna touch anyway, or unlikely to need. And so it's technically you're calling it a bond just because you've got a guaranteed rate of return baked in and a guaranteed payout, as we all turn into angels at some point.
It's a bond that matures exactly when you need it.
Mature, yes, that's right. Now, in terms of corporate structures, if we're thinking about somebody that has a business and has a holdco from the time when they own that business, or a professional like a lawyer or a doctor that's a professional corp or a dentist, what are this? How does when you're thinking about that estate bond, how does insurance help transfer assets from there? Like where's the use case inside that corporation?
The corporate use case is actually even more compelling in some cases than the personal case. And that's because we are able to, the death benefit when paid into the corporation gets paid in tax-free. All life insurance benefits in Canada are paid tax-free. Once it's in that corporation, the death benefit is able to be paid out through the capital dividend account, completely tax-free to the beneficiaries. And that really means that we've taken taxable corporate dollars, we've put them and transferred them into an insurance policy, and we've effectively made them tax-free when paid out through that capital dividend account.
Right. And, can you maybe explain what they're, in effect, it's not technically, but in effect, there's a double taxation at play when you move money out of a corporation, or you liquidate assets in a corporation and then pay them out to settle an estate. Could you maybe just touch on where that double taxation comes in?
Absolutely. So when a traditional investment, something that, for example, would be held in an investment account here at Wellington, sits in a corporation, it pays a lower level of income tax while it's around. When the shareholder passes away, everything becomes taxable, and you pay the investment tax within that corporation. But in order to get those funds out of the corporation, there's a dividend tax that has to be paid, which is on average across the country about 35 to 40-ish% in order to get that out to the next generation. And so while we'll never, ever be an all or nothing recommendation, moving a portion of assets into an insurance policy allow a much higher amount to come out through that capital dividend account.
Right. It's just, it's again, it's a solution. It is not, there's no magic bullets, but it's a solution to
Absolutely
potentially, under the right circumstances, manage a portion of the, managing a portion of that asset transmission.
Absolutely.
From,
and this is something
your assets to the estate and your beneficiaries' assets.
Exactly. We would want to be working with your accountant in a corporate situation to make sure that everybody was on the same page, because I've also had dealings where insurance can help with pipeline planning, where an accountant is given a heck of a lot more flexibility to do things to save even more tax even after the fact. So it's something that should definitely be considered.
Right. And then, as well as you mentioned, you've mentioned in the past, maybe another popular strategy is we touch on, what's known as a cascading or a waterfall type of strategy, and how that works and how you see affluent families using that.
Absolutely. Typically, bigger wealth families like to create and grow their wealth throughout those generations. They like to leave a big legacy and have it continue to grow. So sometimes the people who have the money are a little older or not particularly healthy. So we look at something called a cascading strategy, where we can use a younger or a healthier life within that family line to have the insurance on. So for example, grandma and grandpa fund and own a policy on their children or their grandchildren, but let's say their children. They remain owner their entire lives. So grandma and grandpa have complete ownership and complete autonomy with the cash value. They can do whatever they want with it throughout that lifetime. But upon their death, the ownership will pass automatically to their kids or even their grandkids, completely tax-free. So that's like having a great big non-registered account that's been growing tax deferred, come down, no paperwork, no probate, no fees, no tax, right down. The cash and insurance will then continue to grow until the kids pass away, and then the grandkids get a great big insurance death benefit, completely tax-free. So it's a marvelous way to magnify an inheritance.
Right. Okay. So just moving on here, just the sort of another thing we want to touch on is maybe some considerations. Again, this is a sort of what we'll call a 101 class, where we're just touching off on some of the big points. But what are some of the other considerations? Like, again, this is part of a planning process, but even if it seems like this is a fit, what are some of the other considerations that we have to think about in looking at these types of strategies?
Sure. So I think we alluded to it earlier, but insurance isn't necessarily something that you buy. It's something that you qualify for. And so health and lifestyle are always going to be a consideration when we look at insurance as a strategy in any sense. And as I've also mentioned, in some cases, age or health may disqualify you from buying insurance. That's where strategies like that cascading can come in. There's also some options that we look at, and essentially when we talk about the estate bond, especially if there's, a couple, we talk about something called joint last to die insurance. And I'm sure that most of your clients already know that if partner one passes away, everything will pass tax-free to partner two. And so we don't really need insurance there for tax purposes at that point. What we're looking for is to be able to pay the taxes on that last death. So by looking at a joint last to die policy, it gives us a couple of things. Number one, it gives us a lower actual cost of insurance. So instead of having the cost on, 255-year-olds, it's actually on hypothetically a 41-year-old. Because when we look at those two lives, nothing happens upon the death of the first. It only happens on the death of the second. So we're able to reduce the cost of insurance. We're also able to have one of those lives a little less healthy, even declined if that's the case. We still save a little bit on the cost of insurance, even if one person isn't insurable. And so again, the options created by looking into this type of strategy really opened up, especially because we have those two lives to look at. And then, of course, there's so many different types and structures available. We want to make sure that you're being properly served, and being able to find whether it is a universal life, whether it is a whole life, whether really all you need is that term to 100, because we know what the tax liability is and we know what we want to cover, and we really don't want to put a heck of a lot to it. This is something that we would take into consideration after some underwriting, if that makes sense.
Right. No, that makes sense. Like this is it's part of a process. This is It's not something you pick off the shelf. This is not like buying the way we would buy an investment product, whether it's a stock or a bond or an ETF or a mutual fund. There's a process, and it's, just because we decide that it works doesn't mean the journey's over.
No, absolutely. We need to, once we know what you're looking to accomplish, excuse me, once we know what you're looking to accomplish, we're able to fit something to those goals.
Right. All right. Well, that sounds good. I mean, I think, Connie, that's, thank you very much for that overview here. What I'm going to do now, folks, if you have questions, please put that in the chat. I do have a couple here sitting already that we're going to get to, so I will thank Mark for a great question as well. So what I'm going to do is just come back on a couple questions here, but just as a quick recap before we get into that, again, this is, we want to make sure that we're covering off the basics, why it gets used, who uses it, how do they use it, and some of the considerations that come around thinking about insurance as a potential strategy. It would also want to emphasize that, if you have questions about your own situation, that, we are here to have that personalized conversation with you, and that we want to make sure that, that this is, that you're educated as to what, what these strategies are, and, irrespective of any decisions you make. So just getting into the first question that actually touches on, again, just really upfront, again, you have two spouses. One of them's uninsurable. Can an estate planning strategy with insurance still potentially work?
100%. In a couple of different ways. In general, if one of the spouses is completely uninsurable, we can still have insurance on the two spouses. There's usually 1 year grace, so the insurance age will be 1 year younger than the oldest age there. So that's a good thing. It's still a little bit less expensive, and we still get to have input for both. But there's also some carriers in the marketplace that will look at, let's say, a rated life. So let's say you're still insurable, but your risk is a little bit higher, depending on what that rating is. Some carriers will say, hey, on a joint last to die, even if there's a rating of 150% on this spouse, we're going to issue this standard. So I can't stress enough that if insurance is something that someone wants to consider, we really need to do that underwriting, get that information back, and that gives us even more flexibility to say, okay, both of you are completely healthy. We've got these 20 carriers to choose from. Let's find the best one. Or you're not quite as healthy, but we still have these 2 or 3 that we can choose from. Let's structure that policy to fit what works with you.
Right. Thank you. Next question here comes in the form of, can you change, a beneficiary, for instance, if the beneficiary, first time, you have a marital breakdown or there's some other change in your life, like, is it flexible or is it the beneficiary selection locked in?
So I'm going to say that depends. So number one is if, let's say it's a family that's had the long relationship, it's not a blended family, and you both agree that yes, we want, these two kids to have the assets, you can make the beneficiary designation revocable, which means at any time you can change who those beneficiaries are. When I said it depends, in some cases that I've worked with, we've got a blended family where we want to make sure that the kids from the previous marriage and the kids from the new marriage all have equal settings, or whatever that looks like. You can make irrevocable beneficiary designations as well. So that means that, I bring my daughter into this relationship. I want to make sure that even if I die first, she is on that policy as a beneficiary, and that my partner doesn't change it to his children if I pass away first. So we make them irrevocable. That adds a little bit of administrative something to be aware of. If you want to make any changes to the policy, irrevocable beneficiaries need to sign off, things like that. But you can choose to make it revocable, where you can change it, or irrevocable, where no changes can be made.
Right. So it's, again, this is going to come down to, planning and
Tailoring.
understanding.
Yeah.
No prescription without diagnosis. Again, actually, a quick question I'm seeing. I've had this, there's one more in the chat here, but this is one I know is, I've had this come up a couple times in the last 6 months in speaking with different clients. This is sort of comes down to charities and the use of insurance policies to magnify gifts, or how would you use insurance in the context of giving money to, a cause you feel, very deeply for?
So again, there's a couple of different ways to bequeath funds to a charity. So the first one is I take out a life insurance policy, pardon me, and I want to name a charity as the beneficiary upon my death. So I name the Winnipeg Humane Society, for example, as my charity of choice. And I pay my premiums as I go along. And when I pass away, the death benefit, so let's just say $500,000, is given directly to the charity. And my estate benefits from a $500,000 donation credit.
Right.
Alternatively, I can take out a life insurance policy. And let's say I need that donation credit every year. I take out my policy. I transfer the ownership of that policy to the Winnipeg Humane Society, and I continue to make those monthly or annual premiums. Whatever those premiums are, let's just say they're $5,000 a year. That is what my tax credit is the $5,000 each and every year that I make a donation. So that gives the charity a little bit more flexibility as well. If I decide at some point I don't want to make premium payments, they can find someone else who might want to. And B, with the charity owning that, they have all of the benefits of the cash value. And because they're a charity, they don't pay taxes, they can decide to withdraw funds from a permanent policy and utilize those funds while I'm still alive. So it really depends on when you want to get that tax credit and how much at any given time you want the charity to be benefiting. Does that make sense?
That makes sense. Yeah. So again, we don't want to really drill down on your objectives and such. And I guess a quick follow-up on that is, what happens if you decide to, say, change the charity?
No problem. If you own the policy, you can change the beneficiary at any time, as long as it wasn't revocable and as long as you haven't transferred ownership to that charity.
Right. So as long as you own it, You can change to whichever charity you like. However, if you make them the owner and you deduct the premiums today, then it's locked in.
Done. Yeah.
Makes sense. Makes sense to me. Quick question here, just how, again, this is gonna, I've heard a couple variants of this, and we do have, this is the question sitting in the chat, is how old is too old? And if you're over 70, what are the considerations about, does this still potentially work? Maybe just elaborate on that.
Absolutely. The answer is yes, over 70 works. How old is too old? 85 is absolutely too old. They won't give you any coverage at that point. That's just a hard no. I've recently, in the last 2 years, sold a policy to a 76-year-old female that was a beautiful, fully guaranteed. It was lovely. We doubled her, her investment into it. And when she passes away eventually, it's going to pay out a nice tax-free amount of money. There are options. Not all of them look great. And so I would suggest, and working with Conrad and his team, they are brokers and they can survey 24 different carriers. What we want to make sure is when we put something in front of the client, it actually is going to benefit and enhance where they currently are. And so in my head, I'm thinking it's a beautiful option for someone who's 70, 72, 73. But we would have to decide and work together to see if it actually enhanced the ultimate result. But it can work, and it has worked. So yes.
Right. So we'll have to look into the specifics. So in general, yes, things can work, and it's 70 is still young compared to 85.
That's exactly right. And at 85 is still young too, just not for insurance purposes.
That's right. Well, I mean, it's the old actuarial science thing of the older you are, the older you're likely to become, right? So.
Well, that's very true. I've got an age chart that I have access to, and that's exactly it. So someone who's older than me right now stands the chance to live longer than I will. So yeah, that's
right. That's as is the interesting thing about combining two lives, and you get a younger joint age. I guess
correct.
Actuarial science for fun and profit, but mainly fun.
That's right. That's right.
All right. Last question here, and I think at this point we're going to be running up to our time limit, and we want everyone to get back to their day. So just to, this question, comes in the form of saying, the Canadian banks have, CDIC or Canadian Deposit Insurance Corporation. What happens, is there something similar for insurance companies that operate in Canada? And, what sort of, protections are in place to make sure that, if I bought a premium or bought a policy and I paid a premium, that my beneficiaries in fact see a benefit?
Right. Nope. And that's actually a really, times are always uncertain. So that's also a very good question. There's two things to consider. The first one is, so my regulatory body in Canada, so it's the Canadian Council of Insurance Regulators. They keep pretty close tabs on insurance carriers here in Canada. Each carrier has a minimum reserve amount required to be allowed to carry on business activities. And that's typically a multiple of the death benefit guarantees that they've got on the books already. And so if an insurer gets close to that minimum, CCIR, so Canadian Council of Insurance Regulators, will step in and talk to other carriers and say, hey, we're looking at this. And so in recent years, for example, Maritime Life, so anyone who remembers back in the 80s and 90s, Maritime Life was pretty popular. Maritime Life, their financial situation became not great. And now people who owned those policies now own Maritime Life policies through Manulife. Manulife swooped in, bought Maritime Life, and the responsibility of paying out all those benefits is now transferred to Manulife. That's the first, that's sort of the first step. If something should happen and an insurance company would fail, Assurus ASSURIS, is a not-for-profit organization that guarantees up to $1 million or 90% of the promised death benefit, whichever is higher. But chances are we've never seen anything require assurance yet. It's always been the Paul Revere's of the world, the Maritime Lifes, the Standard Lifes have all been scooped up by the bigger carriers, and the bigger carriers just continue to get bigger.
Right. And so, I mean, from what you're saying is that, the regulation means that the insurance companies have to have multiple dollars of reserves for every dollar of
absolutely
contract.
Absolutely.
And if they get, even the ones that get absorbed, like Maritime Life, are still, they're still dealing, they still have many times more dollars in reserve than they actually have to pay out. It's just that they're managed just extraordinarily conservatively.
Absolutely. It's very, what I've noticed in, there were years in the US many years ago that there were a lot of insurance carriers defaulting. And when you saw that happen, you saw the tightening here in Canada of, we want to make sure that there's more on reserve. We want to make sure that if we had to pay these all out today, there's enough to do it. And so as the insurance regulators tighten things up, we noticed that the insurance landscape tightened up as well. And so we've got a few really, really big carriers. We've got some smaller carriers, but really there's about 8 in the country that are very large. And for anyone who, cares, we really do concentrate on those bigger carriers because they provide the best options and they provide the comfort that we know that our clients want.
All right. Well, thank you very much, Connie, for that answer, as well as their answers to the questions and the format here for today. So I think we'll just wrap things up at this point. We've kind of hit the 45-minute mark, and we don't want to test the endurance of the human concentration or the human bladder.
Absolutely.
So we will leave off here for today. I mean, I would again remind everyone remind all the attendees, that this is the number 2 in a series on estate planning that we're doing, and their number 1 still is on our YouTube and X channels. We will be doing more on this topic as we go forward. Again, it is of keen interest, and we want to make sure that we're putting good educational material out there to make sure that clients, as well as the people that you care about, are making decisions in the context of all of the facts. I would just leave off again by thanking everyone who attended here today. And if you have any questions or there's anything on your mind in general, we are here to help and get the job done. So thank you very much, and please go on and enjoy the rest of your days.
Thanks for having me.